The next thing that we focus on when you want to be a good investor is good investors value process over outcome. What does that mean? Deming had a great quote, which was, if you cannot describe what you do as a process, you don't know what you are doing. So basically, if you're a good active investor, you will always value the process over the outcome. Why is that? Well, because if you know nothing about a process and you're just looking at two numbers, right? You're basing your decision on outcome, like right here. This is the 5-year result of buying the 50 stocks with the best sales gain, annual sales gains, okay? And, you know, if we were looking at this just in isolation, we'd say, wow, simple strategy, makes a good deal of sense to me. I'm going to do that. This strategy outperformed the S&P 500 in 4 of the 5 years that we're looking at here, and it doubled the total return of the S&P 500, right? So you'd think, if I'm looking at that outcome, I love it. And keep in mind, it would not appear to you in a vacuum. Morningstar would have a 5-star rating on this fund. CNBC would have this manager on and talking about why this is such a great strategy. Forbes, Fortune, Wall Street Journal, Barron's would all be writing glowing stories about this guy or gal. They would say, they've got the keys to the kingdom here. This is amazing. Okay, this is what happens when you value outcome over process. Let's go to the next slide and see what really happens here. Well, what really happens here is you're wiped out. This is the data between 1964 and 2009. Over to the left is that very same strategy. That strategy did vastly worse than T-bills, okay? Everything else killed it. So let's all imagine that there is a bar graph there for the S&P 500 that says you put your money there, you got $640,000, and all stocks doesn't even have a number, but it's better than the S&P 500. The point is a pretty simple one. If you have access to the long-term data, you're going to get much better information about whether the process that you're looking at actually makes sense. For the most part, they don't. Like buying the stocks with the 50 highest sales. Oh, by the way, these numbers are from 1964 to 1968. People who don't understand market history is, you know, it's like Twain said, history doesn't repeat itself, but it rhymes, right? So in 1964 to 1968, we had a bubble just like the dot-com bubble, and it led to all sorts of things that we don't have time to get into. But in terms of practical human nature, they behaved exactly the same then as they did in the dot-com bubble. And then for people who don't like the idea of, well, 60s, that's meaningless. This same strategy for the 3 years ending February of 2000 compounded at 66% per year for the prior 3 years as of February 2000. Boy, that's really difficult to ignore. And the only way you can ignore it is if you look at the much, much longer term in terms of the underlying strategy and how it performs. When you value process over outcome, right, what becomes important to you is to study as much data as you have available to you to see how things in general turn out. You're not always going to be right, right? So one of the reasons why that strategy does very poorly is because guess what happens? Everyone buys those stocks and they become enormously expensive, right? They're priced to perfection and they don't achieve it, right? So Murphy would be good here. Murphy was an optimist. If it can go wrong, it will go wrong, and generally does. What we've found in doing the study is that when you pay for the most expensive stocks, you manage to subtract about 6.2% from the return from the index.